Retirement might seem like a long way away, or it might be rolling up on you faster than you think. Either way, your business can help you fund your retirement plan. That is why in this video, I am going to break down for you the different type of retirement plans that you can have and how you can make them tax effective. But before we jump in, you know what to do. I'm going to need you to like, comment, and subscribe so you don't miss out on any of this wealth building information. There are so many retirement options for small business owners, and the key is to understand some basic things. Number one, if you are setting up a retirement plan and you're starting out as a business owner, you probably want to set up a retirement plan that is going to be tax deferred, that is going to lower your income tax based on your contributions. One such plan is called a SEP IRA, a self-employed pension plan. This plan allows you to put up to 25% of your income from business away in a deferred account up to $66,000. That doesn't mean you have to put in $66,000. You can put in $6,000 or $10,000. The key is to put in something into your SEP plan. In addition, you can also look at having a solo 401k plan. 401k plans used to be for employers that had a lot of employees, and a lot of business owners missed out on being able to have a 401k. Now they have the solo 401k, meaning if you own your business by yourself, you can put into your own 401k plan up to $66,000. And again, it can be tax deferred. The solo 401k plan and its difference between the SEP is that the solo 401k plan allows you, the business owner, to contribute like an employee, and it also allows the business to contribute a profit sharing piece like the employer. So you get both sides of the equation, and you can really help to build up your retirement savings pretty rapidly. A simple IRA is another way that you can reduce your overall taxes and have deferred money as well. It is exactly what it says. It's a simple IRA that will allow you to contribute upwards of $15,000 into your simple IRA. Either way, the key is, as you are building your business, set money aside for your retirement plan. Even if you start off with $1,000 a year, I guarantee you'll be glad that you did. If your business is really booming and you have more profit than you can deal with, if you need more than a basic 401k, simple IRA, or SEP, then you can get what they call a defined benefit plan. A defined benefit plan will allow you to define the amount of the benefit that you want to set aside, tax deferred. There are some requirements to have a defined benefit plan. You're going to definitely need to have W-2 wages. And once you contribute to a defined benefit plan, the law also requires you to contribute for 3 years. So you gotta really make sure that your business is doing extremely well. But this is a great way to lower your taxable income when your business is really booming and you need to put in a chunk of money. And I'm talking about clients are putting in upwards of $300,000 into these defined benefit plans on a yearly basis. That's a great way to drop your income very quickly. The key is you gotta make sure you put something in place before December 31st. When you are thinking about your retirement plan, one thing you need to think about is reinvesting in your business. Part of your retirement could be the sale of your business. So make sure that you have some mechanism in place where you are contributing funds back into your business to grow your business, to help with the technology of your business, and to make sure that your books and records are in place. I cannot tell you guys how many businesses that I have seen that were not able to be sold because they drained all of their profit and never invested back in their business. Remember, an investment in your business is an investment in yourself. So think of your business as part of your retirement plan. In addition to setting up a retirement plan, some other things that you need to make sure you do is set up a health savings account, an HSA. A health savings account is an investment in making sure that you can pay for your health care tax deferred. A lot of individuals have to pay out of pocket. And with a health savings account, you can set aside as an individual up to $3,850 and as a family upwards of $7,700. That means that when you go pick up prescriptions and they're $20 here and there, you can then get reimbursed from your health savings account, which is tax deferred. What's really important, business owners, is that you take the time to understand the little things that can really help you reduce your overall income. Don't think you need to make that winning score. If you don't get that 3-point play, you're not gonna win the game. In business, you win the game by doing little things over and over again. That is why setting up a retirement plan, whether it is a SEP IRA, whether it is a simple or whether it's a 401k, is mission critical. Put in a little and it will grow a lot. It's also very important for you to look at things like your health savings account. Set that money aside so you can have tax deferred payments of your health insurance or your out-of-pocket costs. It's also important to reinvest back in your business. Don't drain your business of all the income that it has, because reinvesting back in your business is an investment in you, an investment in your long-term growth of your business, and possibly selling your business to help fund your retirement in the long run. A lot of you like to ask some questions, and one of the questions that I frequently get in my comments: can real estate be a part of your retirement portfolio? I believe that real estate can be a part of your retirement portfolio, but it's so important for you to understand how to make real estate a part of your retirement portfolio. Are you going to pay down the loans on the actual real estate that you purchase so that the rents coming in from the real estate become your annuity when it comes time for you to retire? Or are you going to sell your real estate portfolio off and get capital gains and live off of the capital gains? Having a tax strategy around real estate is mission critical, because there's another element, the timing of the market. So if you want to retire off real estate, it's important to understand the timing of the market and the time you spent in the market, meaning how long you've owned your real estate. Another question that came in is, how important is tax planning to retirement savings? It's mission critical. When I see my business owners, my entrepreneurs that are really starting to make money, they're starting to hit $150,000, $250,000 in taxable income, and they are paying outrageous amounts in tax. You need to be tax planning, and you need to start now. Even if you have any amount of taxable income and profits from your business, set aside $100, $200, $300 into a retirement account. You will be thanking me later on that you did that. Don't think that retirement has to start when you're making big bucks. Retirement starts with tax planning, and tax planning starts now. As a business owner, it is so important that you use your business to fund your retirement strategies, but understanding how is mission critical. Don't forget about the deferred accounts that you can set up, having deferred money. Don't forget about reinvesting back in your business so that business, that asset, can grow and possibly be sold. Don't forget about the little things, having a health savings account so you're not paying extra extra money out of your pocket that is going to be taxable. It's important to look at all of those things, because at the end of the day, when you know better, you have to do better. And you are the only person responsible for making sure you can make it in retirement. So don't let taxes eat up your retirement funds.